fluctuates, you're guaranteed to receive these interest payments. Additionally, if the organization you've lent money to is unable to fulfill its promise, bondholders are typically paid before shareholders. This gives an extra layer of security to bond investments. But it's not all sunshine and rainbows. With lower risk comes lower potential returns. Unlike stocks, which can skyrocket in value, bonds offer a fixed return. You won't get any nasty surprises, but you also won't wake up to find your investment has doubled overnight. So who are bonds ideal for? If you're someone who prefers stability over uncertainty, bonds could be a good fit. They can provide a steady stream of income and are less likely to keep you up at night worrying about market volatility. However, the key to successful investing is diversification. This means spreading your money across different types of investments to balance risk and reward. While bonds may form a portion of your investment portfolio, they shouldn't be the entire story. Bonds can be a safer option than stocks, but they also have lower potential for returns. It's important to consider your financial goals and risk tolerance when choosing your investments. Next up, we're going to talk about mutual funds. These are investment vehicles that pool together money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Because they involve a wide array of securities, mutual funds offer a level of diversification that can be quite challenging to achieve if you were investing on your own. Consider this. You're at a potluck dinner. Instead of bringing just one dish, a mutual fund is like bringing a little bit of everything on the table. You get to sample a variety of flavors, and if one dish isn't to your liking, it doesn't ruin the entire meal. That's the beauty of diversification. Now, let's touch on risk and returns. Mutual funds can be seen as a middle ground. They typically offer higher returns than bonds, but come with less risk compared to individual stocks. This is because the risk is spread across a wide range of investments. If one company in the fund performs poorly, the impact on the overall investment is lessened by the performance of the other companies in the fund. However, it's important to remember that all investments come with some level of risk. Even though mutual funds are diversified, they can still lose value if the overall market declines. Hence, it's crucial to consider your risk tolerance and investment objectives before diving in. Another advantage of mutual funds is accessibility. Most mutual funds allow you to start investing with a relatively small amount of money. This makes them a popular choice for beginner investors who are just starting to build their portfolio. Lastly, it's worth noting that mutual funds are managed by professional fund managers. These are experts who make investment decisions based on thorough research and analysis. Mutual funds offer a way to diversify your investments, balancing risk and returns. But it's crucial to understand the fund's objectives before investing. So, take your time, do your research, and make sure the mutual fund aligns with your financial goals and risk tolerance. After all, investing is not just about making money. It's about making informed decisions that help build your wealth for the future. Now, why is it so important to start investing early? Well, imagine a snowball rolling down a hill. As it rolls, it picks up more snow, growing bigger and faster with each roll. That's the power of compounding at work. Compounding, in the context of investing, is when your earnings generate even more earnings. You receive interest not only on your original investments, but also on any interest, dividends, and capital gains that accumulate, so your money can grow faster and faster as the years go on. Starting early gives your investment more time to grow, just like that snowball. Each year's gains can generate their own gains the next year, a powerful wealth-building phenomenon known as the compounding of returns. Let's say you start investing a small sum every month at the age of 25, instead of waiting until you're 35. By the time you're 65, you could have twice as much money as if you'd started 10 years later. That's the power of starting early. But it's not just about the money. Starting early also gives you the luxury of time, which can be just as valuable. With more time, you have the flexibility to ride out the ups and downs of the market, making it less likely that you'll need to pull your money out at a bad time. It also allows you to take on a bit more risk in the early years, potentially reaping greater rewards in the long run. Moreover, starting early can help cultivate good financial habits. Regular investing, much like regular exercise, can lead to significant long-term benefits. It becomes a habit, a part of your life, and not just something you scramble to do at the last minute. So let's revisit our snowball one last time. The sooner you start it rolling, the bigger it can get, and the longer it can roll. That's why starting early in your investment journey is so crucial. Time can be an investor's best friend. The sooner you start investing, the more potential your money has to grow. So where does this leave us? We've journeyed through the basics of investing, understanding the unique appeals and potential pitfalls of different investment options. From the adrenaline-fueled world of stocks, where fortunes can be made or lost with a single decision, to the more stable and predictable realm of bonds, offering a safer, though perhaps less exciting, path to financial growth. We've also explored the middle ground of mutual funds, where diversity and professional management can help balance risk and reward. But the most important lesson, the golden nugget of wisdom, is the profound impact of starting early. Time is the most valuable asset in the world of investing. It allows for the magic of compounding to work its wonders, turning small, consistent investments into a substantial nest egg. Investing is not a get-rich-quick scheme. It requires patience, discipline, and informed decision-making, but the rewards are well worth it. Remember, the journey to building wealth starts with a single step. Make that step today and secure a better financial future.